The day you retire, the IRS starts a new game with you, and nobody sends you the rules. No welcome letter, no checklist in the mail, no phone call from Social Security explaining what just changed. You go from a system that ran on autopilot to a system where every single decision is yours and every single mistake costs you money. Look, this is not theory. Every single item on this list has a dollar amount attached to it. And if you miss all 10 of them, you will hand the IRS an extra $14,000 in your first 2 years of retirement. I have watched it happen. Today, I am going to walk you through the complete checklist. 10 things the IRS expects you to do the moment you retire. Most retirees miss all 10. Let us fix that. Quick disclaimer before we start. This video is for educational purposes only. It is not tax or financial advice. Always consult a qualified tax professional before making any decisions about your specific situation. All right, number 1, set up estimated tax payments or you will pay a penalty. When you were working, your employer handled everything. Federal tax, state tax, Social Security, Medicare, all of it withheld automatically from every paycheck. You never had to think about it. Retirement ends that. Your income now comes from Social Security, from your pension, from IRA withdrawals, from dividends, maybe rental income. And here is the problem nobody warns you about. Most of those sources do not withhold enough tax. Social Security only withholds if you ask for it, and even then, usually not enough. IRA withdrawals often default to 10% withholding, but your actual tax rate might be 22%. The gap adds up fast. If you do not pay enough tax throughout the year, the IRS hits you with an underpayment penalty. And that rate changes every quarter based on the federal short-term interest rate. For the first quarter of 2026, the penalty rate is 7%. For the second quarter, it dropped to 6%. The penalty is calculated daily on the underpaid amount for every quarter you were short. The fix is simple. Make quarterly estimated tax payments. 4 deadlines: April 15th, June 15th, September 15th, and January 15th of the following year. You can set them up in 5 minutes at irs.gov payments. Here is the safe harbor rule that protects you. If you pay 100% of last year's tax liability through withholding and estimated payments, the IRS cannot penalize you no matter what you actually owe this year. 110% if your income was above $150,000. Let me put dollar numbers on this so you see the stakes. Say you retired in 2025. You are 66 years old. You collect Social Security. You withdraw from your IRA. You have some dividend income. Your total tax liability for 2026 ends up being $14,000. You had $8,000 withheld through the year from various sources. That leaves $6,000 underpaid. You did not make any estimated payments because nobody told you to. The IRS calculates the penalty on that $6,000 across 4 quarters at the current rate. When you add it all up, you are looking at roughly $300 to $400 in penalty on top of the $6,000 you already owe. Here is the part most new retirees do not know. The IRS has a waiver specifically for seniors. If you are 62 or older, if you retired in the last 2 years, and if you had reasonable cause for underpaying, they can waive the penalty entirely. But they do not apply automatically. You have to file Form 2210 with your tax return and check the box for the waiver. If you just file normally and pay the bill, you will pay the penalty and never know the waiver existed. Write that down. Form 2210. It is free money if you qualify. Number 2, file Form W4V to withhold taxes from your Social Security. Most retirees do not realize their Social Security benefits can be taxable. But if your combined income exceeds $25,000 as a single filer or $32,000 married filing jointly, up to 85% of your benefits can be taxed. 85% of the money you paid into the system for 40 years. Here is the fix. File Form W4V voluntary withholding request with the Social Security Administration. You can also do it online through your My Social Security account at ssa.gov. Takes 5 minutes. You choose from 4 flat withholding rates: 7%, 10%, 12%, or 22%. Pick the one that matches your actual tax bracket. This single form prevents the surprise April tax bill that hits millions of retirees every single year. The people who skip this step are the same people writing $4,000 checks to the IRS in April and wondering how it happened. Number 3, understand the provisional income formula that taxes your Social Security. The IRS uses something called provisional income to decide how much of your Social Security gets taxed. The formula is not complicated. It is your adjusted gross income plus any tax-exempt interest plus half of your Social Security benefits. That is your provisional income. If that number lands between $25,000 and $34,000 as a single filer, up to 50% of your benefits become taxable above $34,085%. For married couples filing jointly, the thresholds are $32,000 and $44,000. Here's the piece nobody talks about. Those thresholds were set in 1983 and 1993. They have never been adjusted for inflation. Not once. In 1983, of a combined income of $25,000 meant you were doing well. Today, it is a modest retirement. This frozen threshold now catches 56% of all Social Security recipients. More than half. Every dollar of additional income you bring in does not just get taxed at its own rate. It can push more of your Social Security into the taxable zone. The effective marginal tax rate for retirees in this income range can hit 30 to 50%. Because each dollar of extra income triggers taxation on benefits that were previously untaxed. Understanding this formula is not optional. It is how you control your tax bill in retirement. Because once you see the math, every income decision you make starts to look different. Number 4, claim the $6,000 senior bonus deduction. This one is new, very new. The One Big Beautiful Bill created a brand new deduction for taxpayers age 65 and older. $6,000 per person, $12,000 for married couples filing jointly where both spouses qualify. And here's the key part. This is on top of the regular standard deduction. It is on top of the existing additional standard deduction for seniors. It stacks. The income limits are $75,000 for single filers and $150,000 for married filing jointly. Above those limits, it phases out. Below them, full benefit. And this deduction is only available for tax years 2025 through 2028. It is temporary. After that, it is gone unless Congress renews it. It gets filed on the new Schedule 1A. Here is the warning. Not all tax software is flagging this deduction automatically. Ask your preparer specifically whether they applied it. Look at your return. Find Schedule 1A, confirm it is there. If you already filed without it, you can amend your return within 3 years and claim it retroactively. That is real money you leave on the table if you file on autopilot. Number 5, know when your required minimum distributions start and never miss one. If you have a traditional IRA or a 401k, the IRS requires you to start taking minimum withdrawals at age 73. These are called required minimum distributions, RMDs for short. The amount is based on your account balance on December 31st of the prior year divided by a life expectancy factor from the IRS Uniform Lifetime Table. You must take your first RMD by April 1st of the year after you turn 73. Every RMD after that is due by December 31st. And here is the trap that catches thousands of new retirees every year. If you delay your first RMD until April 1st, you will have to take 2 RMDs in the same calendar year. Your delayed first RMD and your on-time second RMD. 2 distributions hitting your tax return at once that can push you into a higher tax bracket, make more of your Social Security taxable, and trigger IRMAA surcharges on your Medicare premiums. A triple hit from a single timing mistake. The penalty for missing an RMD entirely is 25% of the amount you failed to withdraw under the Secure 2.0 Act. That drops to 10% if you correct it within 2 years. But 10% is still a massive penalty on money you were going to withdraw anyway. Let me show you the math with real numbers. You turned 73 in 2025. Your IR balance on December 31st, 2024 was $500,000. Your RMD for 2025 is approximately $19,200 based on the Uniform Lifetime Table. You have until April 1st, 2026 to take that first RMD. But if you wait until April, you also have to take your 2026 RMD by December 31st of that same year. That means 2 RMDs in 1 calendar year, roughly $38,000 in IRA withdrawals hitting your tax return at once. That can push you from the 12% bracket into the 22% bracket. It can make 85% of your Social Security taxable when it was previously 50%. And it can trigger an IRMAA surcharge on your Medicare premiums for the following 12 months. Taking your first RMD in the year you turn 73 instead of delaying until April avoids all 3 hits at once. Do not delay. Not for convenience, not for any reason. Number 6, use Qualified Charitable Distributions to satisfy your RMD tax-free. This is one of the most underused strategies in all of retirement tax planning. If you are 70 and a half or older, you can donate up to $111,000 directly from your IRA to a qualifying charity. It is called a Qualified Charitable Distribution, QCD for short. And here is what makes it magic. The donation counts toward your RMD, but it does not count as taxable income. It does not increase your adjusted gross income. It does not push your Social Security into the taxable zone. It does not trigger Medicare IRMAA AC charges. None of those dominoes fall. If you were going to give to charity anyway, routing the donation through a QCD instead of writing a check from your bank account is dramatically more tax efficient. Same donation, different source. thousands of dollars saved. Here is the detail most retirees miss. The QCD has to go directly from your IRA custodian to the charity. You cannot take the money out of your IRA first and then write the check. The moment that money passes through your hands, it becomes taxable income. Talk to your IRA custodian. Tell them you want to make a qualified charitable distribution. They know exactly what that means, and they will send the check directly to the charity on your behalf. Number 7, consider Roth conversions during the gap years. The years between when you retire and when you turn 73 before RMDs start and potentially before you claim Social Security, those are called the gap years. And during the gap years, your income is often at the lowest point of your entire adult life, which means your tax bracket is at its lowest too. This is the optimal window for Roth conversions. When you convert money from a traditional IRA to a Roth IRA, you pay income tax on the amount you convert right now. But once that money is in the Roth, 3 amazing things happen. It grows tax-free. Withdrawals in retirement are tax-free, and there are no required minimum distributions during your lifetime. The tax you pay now at a lower bracket saves you from a much higher effective tax rate later. Because later, when Social Security, RMDs, and IRMAA all stack on top of each other, your effective tax rate can be 30 to 50%. A down market makes Roth conversions even more attractive. You convert at a lower dollar amount, pay less tax, and all of the recovery growth happens inside the Roth tax-free. Here is the math. Say you convert $50,000 from a traditional IRA to a WTH while the market is down. You pay income tax on $50,000. If the market recovers 20% over the next 2 years, that $50,000 grows to $60,000 inside the Roth completely tax-free. If you had waited until the market recovered to convert, you would be converting $60,000 and paying tax on the full $60,000 at a 22% bracket. The down market saved you $2,200 in taxes on that one conversion over a decade of smart gap year conversions. That adds up to tens of thousands of dollars. The ideal strategy is to convert just enough each year to fill your current tax bracket without spilling into the next one. A tax advisor can calculate the exact amount. Do not wait on this. Every year you delay is a year of conversions you cannot get back. Every year your traditional IRA balance grows, the future tax bomb gets bigger. Number 8, watch out for IRMAA, the Medicare premium surcharge nobody warns you about. IRMAA stands for Income-Related Monthly Adjustment Amount. If your modified adjusted gross income exceeds certain thresholds, Medicare tacks on a surcharge to your Part B and Part D premiums for 2026. The first IRMAA bracket starts at $106,000 for individuals and $212,000 for married couples filing jointly. Above those levels, your Medicare premiums can jump by $70 to over $400 per month per person. And here is the brutal part. The surcharge is based on your tax return from 2 years prior. So, a spike in income today does not hit your Medicare premium for 2 full years, which means you do not see the damage until it is already locked in. A single large IRA withdrawal, a one-time Roth conversion, or a single capital gain event can push you over the threshold for 1 tax year and increase your Medicare premiums for the next 12 months. Here is the escape hatch most retirees do not know about. If the income spike happened because of a one-time life-changing event, retirement itself, the death of a spouse, a divorce, loss of pension income, you can file Form SSA 44 with the Social Security Administration and request a reduction. It is called the Medicare Income-Related Monthly Adjustment Amount Life-Changing Event Form. Free, takes an hour, can save you thousands over the next year. Most retirees never hear about it. Number 9, update your address with the IRS and never ever ignore their letters. When you retire, a lot of people move, downsize, relocate to a lower tax state, move closer to grandkids. But if you moved and you did not notify the IRS, they are still sending notices to your old address. File Form 8822 to update your address with the IRS. It is free. It takes 5 minutes. And then open every single letter the moment it arrives. Every IRS letter has a deadline. Everyone missed that deadline and you lose your right to dispute, to appeal, or to negotiate. The IRS does not care about your excuse, they care about the date on the letter. If you receive a notice and you are not sure what it means, do not put it in a drawer. Open it immediately. Here is a quick decoder for the most common ones. ACP 14 notice means there is a balance due. ACP 2000 means the IRS believes your return does not match their records, usually because a brokerage or employer sent them a document you forgot to include. A NLT-11 or Letter 1058 is the final notice of intent to levy, which means the IRS can seize your assets in 30 days. Wage garnishment, bank account levy, social security levy, all of it on the table. If you see LT-11, you call a tax professional that same day. Not next week, not after the weekend, that same day. Number 10, run the numbers on standard deduction versus itemizing every single year. The standard deduction for 2026 is $16,100 for single filers and $32,200 for married filing jointly. On top of that, seniors 65 and older get an additional $250 per person. And on top of that, the new senior bonus deduction, the one we talked about in number 4, adds up to $6,000 per person for a married couple both over 65. The combined standard deduction plus both senior add-ons plus the bonus deduction can exceed $47,000. $47,000 of income that is completely tax-free. But, and this is the big one, the ST deduction cap just jumped from $10,000 to $4,400 under the One Big Beautiful Bill. If your state and local taxes plus mortgage interest plus charitable contributions exceed your standard deduction amount, you should be itemizing. Millions of homeowners switched to the standard deduction back in 2017 when the SAT cap first dropped to $10,000 and they never looked back. The cap has changed, but their filing habits have not. Run the numbers every year. Do not file on autopilot. The difference between the right choice and the wrong one can be thousands of dollars. Let me give you a quick example. A married couple, both 67, living in New Jersey. Property taxes $16,000, state income taxes $9,000, mortgage interest $4,000, charitable contributions $3,000, total itemized deductions $32,000. Their standard deduction with both senior add-ons and the bonus deduction is about $47,000. Standard deduction wins by $15,000. They should not itemize. Now take the same couple, move them to Connecticut. Property taxes $22,000, state income taxes $14,000, mortgage interest $8,000, charitable contributions $5,000, total itemized deductions $49,000. That exceeds their standard deduction by about $2,000. They should itemize. And if they have been taking the standard deduction on autopilot since 2017, they have been leaving $2,000 a year on the table. Over 5 years, that is $10,000 gone, just from not rerunning the math. The SAT cap change from $10,000 to $40,400 is the single biggest reason to rerun this calculation in 2026. If you live in a high property tax state and you have not checked since the cap was at $10,000, check now. All right, let me bring it all together. Here are all 10 in order, so you have the checklist. Number 1, set up estimated tax payments before the next quarterly deadline. Number 2, file Form W-4V to withhold taxes from your Social Security. Number 3, calculate your provisional income so you know exactly how much of your Social Security is taxable. Number 4, claim the $6,000 senior bonus deduction on Schedule 1A. Number 5, know when your RMDs start and never miss one. Number 6, use Qualified Charitable Distributions to satisfy your RMD tax-free. Number 7, do Roth conversions during your gap years while your tax bracket is at its lowest. Number 8, watch for IRMAA and avoid one-time income spikes that raise your Medicare premiums. Number 9, update your address with the IRS and open every letter the moment it arrives. Number 10, run the numbers on standard deduction versus itemizing every single year. 10 things the IRS expects you to do. Most retirees know 0 of them on the day they retire. And every single one you miss cost you real money. Here's the thing I want you to remember from this video. When you retired, you did not just leave your job. You left the system that was doing your taxes for you. The IRS does not send you a welcome letter when you retire. They send you a bill, and if you do not know the rules, the bill only gets bigger every single year. If this video saved you money, hit the like button. If you know somebody about to retire, send Snorts It to them today. This is the checklist nobody else is going to give them. I will see you in the next